Good evening, everybody. It's Sunday, June the 12th. Lots to talk about after last week. Nothing should have come as a surprise to anybody, even though they say it did. But let's get started. Let's talk money. Let's talk Sunday market preview. All right, everybody, so let's just jump right in here. There's a lot of points I really want to talk about. I'm not sure I'm going to touch on all of them, but let's talk about last week first, because last week the markets really did finish pretty brutally. The Dow Jones finished down about 880 points. The S&P 500 finished down about 116, still out of bear territory. But considering the beginning of the week, which started off actually very favorably and positively, even though I did on Sunday discuss that we will probably see some significant volatility towards the end of the week with the announcement of the inflation rate, which we knew was going to be higher than expected. Anybody who expected it to be lower or better, I don't know what to tell you, because that was absolutely not a possibility. Mathematically, it's not a possibility. Even the Fed's own comments indicated that it was not likely going to happen. And in fact, we were going to anticipate an increase in inflation in the short term. That's directly from the Fed from a few weeks back, possibly a month and a half ago. Now, the major concern, I think, for the markets this week wasn't so much the initial jobless claims are absolutely brutal and a massive miss. Not only that inflation was a massive miss and accelerated to the upside, but I think the major concern here is what the Fed will do this coming Wednesday and whether or not the Fed will actually increase and be more aggressive than initially stated, or than Powell stated most recently, where we were anticipating a 50 basis point increase. Will they increase by as much as 75 basis points? Now, here's the thing, and I've been getting a lot of emails and people concerned and questioning whether or not this is the beginning of the big one, the big correction. The roof and sky are falling. If we see an increase of 75 basis points, I'm going to say that yes, we will see a market pullback that'll be very significant, easily pushing markets into bear territory. And where the bottom is, I honestly don't know. Will there be a bottom? It'll slow down until the next interest rate increase. And if that is a 50 basis point, then we'll see a little bit of recovery. Obviously, if it continues being aggressive in another 75 point increase, the markets will absolutely fall apart. If we see a 50 basis point increase, the story could very likely be different. And keep in mind, 50 basis points is the most likely scenario for at least this round. We could very likely see, in the event of a 50 basis point increase on interest, a bounce or a rebound in the markets. And that will be very positive, obviously. And it will continue to maintain that positive momentum to the upside over the next at least few trading sessions, essentially wiping out this week's negativity. But again, there is that slim possibility, although I don't feel it's necessarily the case, there is that slim possibility that the Fed could increase by 75 basis points. But I do want to bring attention to something else, and that's the 10-year yield, because as we've seen, the 10-year yield this past Friday increased by 10 basis points, which is a very, very significant, from a percentage perspective, increase. Now, if we continue to see these increases, that could be the indicator of a market correction, the likes of which we probably haven't seen, which could potentially erode as much as 60% of the market from where it is today. Now, that is the indicator. That's not the absolute. Obviously, there is a degree of interference by the Fed in terms of the calculation of the 10-year yield. So there is some possibility for a bit of inaccuracy there. But that being said, if we take a look at the 10-year yield and we continue to see these big jumps to the upside, including the announcement on Wednesday, that may indicate an implosion of the debt market, and that would essentially become the big one. And as a result, portfolios need to be adjusted and moved as appropriately. Now, that being said, there is a lot of positivity in the market. Let's take a look at areas that I've been talking about since pretty well the beginning of the year. They are higher risk and do see significant volatility, but crude and energy are up approximately 50% this year. We have seen a very significant move to the upside in commodities. We have seen a very significant move to the upside, specifically in agriculture, in wheat, in rice, soy, corn. We've seen a significant move to the upside in lumber or wood. And we've seen a very decent rate of return for precious metals as well. So right across the board, commodities have seen a nice increase to the upside. Energy has seen a nice increase to the upside, including the fact that a lot of energy companies, funds, ETFs, have dividends as well, which I anticipate that these markets will continue to move to the upside, especially for the medium term. And they will move up quite aggressively, keeping in mind, especially energy, there will be some significant volatility, but it would be volatility as momentum continues to move to the upside. In fact, crude, last I took a look at, although there was a bit of a pullback, was comfortable around 120. That is near the high of the year where we saw it reach 125 a few months back. It actually broke 120, went up to as high as 121 and a half in the last few weeks. And so I continue to anticipate that commodities, I do anticipate that right across the board, we're going to see a very significant increase there. Still, that is factoring in inflation, that is factoring in supply chain, that is factoring political turmoil, that is factoring in just about every angle and element, including supply and demand, right across the board. That being said, if we go back to interest rates and where I see the markets and where I see the economy moving in the next 6 months, I do anticipate that we will see a recession. And I'm very confident in that. And I think that's going to put the Fed in a very delicate or very significant place to be, because the Fed at that point has two options, and we've spoken about this before. They can either allow inflation to go out of control, change course, start quantitative easing rather than supposed quantitative tightening, trying to avoid the recession, or they're going to allow the recession to continue to force inflation down just simply by the result of slowing demand. And as a result, prices will start to come back down without interference by increased or continued increased interest. The problem is either way, when we look at the average Joe, that's where the pain will be. Either affordability, so we know right now inflation at the pumps are very significant, inflation in the grocery stores are very significant. People are starting to feel the pinch of even going back to work in office, where finances just from transportation alone are impacting the bottom line, where many people are starting to realize that it's not even worth going into the office anymore and are actually resigning. The other area that we really need to focus on is, should we fall into a recession, what happens to the job markets, especially in the US, where we're seeing initial jobless rates continue to increase pretty well week over week, minus the occasional anomaly like the previous session. What happens as we see mortgage rates start to increase? I recently read an article here in Canada that suggested that for a very significant number of mortgage holders, the next renewal could see as much as a 30% increase to your mortgage costs. People, especially in Canada, in major urban areas, are finding that they are already paycheck to paycheck because the cost of properties have increased at such a dramatic rate. And if property values start to drop because people can no longer qualify for mortgages, what happens to the value of those assets for people who are banking on the fact that their wealth, their net worth is in their home? Lots to think about over the next few weeks, next few months. The main thing, if we take a look at our portfolios, is you need to be prepared for a defensive position, I think, at this point, regardless. A 50 basis point increase will allow you to see some recovery on your equities, but you really need to start to look at diversification on a grander scale. I myself, as I've talked about before, am quite comfortable with precious metals and comfortable with commodities, comfortable with crude, comfortable with positions like that. And that is my personal opinion. All of this is obviously my personal opinion and where I think the markets will go. I know I've jumped around a little bit here between economy and markets, but that's essentially where I'm looking for the next 3 to 5 months, 3 to 6 months, considering right until the end of the year and even beyond. I'm looking at possible corrections in the debt market, which would absolutely annihilate equity markets. So we're keeping a very close eye on the 10-year yield. It will settle at around 3.25. If it goes up to 3.30, 3.40, we're starting to look at it's really not going to be positive at that point. However, anticipating the increases in interest rate, it wouldn't surprise me if we do hit 3.30 or 3.35. But otherwise, I think we'll probably sit around 3.25 for the 10-year yield. Once we hit that, if we see more bumps, that's significant. I do think we're going to get that 50 basis points, so we'll watch for that on Wednesday. And if that's the case, we will absolutely see a recovery in the market, at least a short-term rebound here, which may allow you to position yourself if you choose to de-risk at that point. 75 basis points will cause a major drop in the market. And I think it really comes down to what we're going to see this week. This video is long enough. I'm going to be posting more frequently this week, just as the markets continue to go through, especially on Wednesday. But for now, I will see you tomorrow morning at the opening.